Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Enphase Energy stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 18 billion market cap. They're trading at $133 a share and they have 136 million shares outstanding. Enphase designs, develops, manufactures, and sells home energy solutions for the solar photovoltaic industry in the US and around the world. They offer a semiconductor-based microinverter which converts energy at the individual solar module level. They also provide microinverter units and their related accessories. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks a lot better than First Solar. It's positive every year, peaking in 2022 at $700 million. And they have pretty good margins, above 20%. Their highest in 2022, 30%. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was highest in 23 at $439 million, down 37% in the trailing 12 months at $276 million. Also pretty decent margins in the mid to high teens. Revenue is the sales for the company, and that went up a lot from 21 to 22, up 69%, but then it's been coming down since then. That's not what you want to see. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $19 billion. We discounted the numbers back to today using the weighted average cost of capital. We get a value of the company of $16 billion. We divide that by 136 million shares. And we get a calculated stock price of $118. They're trading at $133, so they're trading at a 13% premium. It's a sell according to the model. I'm projecting their free cash flow to be $1.2 billion by 2027, a pretty decent growth, but they still seem overvalued. There are 26 companies in the same industry as Enphase, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much on CapEx, only $100 million. They are a bit leveraged. For every dollar of equity, they have $1.40 of debt. They do not pay a dividend. They have positive free cash flow, one of 4 companies in this industry to be positive. They rank second in market cap, more than double Nextracker. Their price multiples look pretty bad. They're trading at 65 times earnings, 45 times free cash flow. But at least they have positive free cash flow. Most are negative, that's why it says NA with a lot of companies. They're trading at 10 times revenue, which looks a bit pricey. They generate $1.8 billion of revenue, which is a little higher than the average. And they're still growing a lot. Their 5-year annual revenue growth rate is 39%. If you put $10,000 into this company 10 years ago, you'd be really happy at $148,000 today. That's a 31% annual return. But at one point, your $10,000 would have been over $300,000. Let's take a look at their most recent 10Q. We'll start with their income statement. Look how much their revenue went down. It was over $700 million, now it's $260 million. Let's try to get some more info on their revenue. Of the $260 million of revenue, $150 million is in the US, $113 million international. This paragraph gives more info on their revenue. Revenue decreased $463 million or 64% in 1Q 2024 compared to 1Q 2023. It was mainly due to a 71% decrease in microinverter units and a 20% decrease in IQ batteries megawatt hours shipped. In this quarter, they only sold 1.4 million microinverter units. Last year, 4.8 million units. They shipped 75.5 megawatt hours of IQ batteries compared to 102 megawatt hours. The overall decrease in revenue was due to a broad-based slowdown that began in the second quarter of 2023 in the US and the second half of 2023 in Europe. The result was elevated inventory with distributors and installers. And as a result of that, we sold fewer microinverters to distributors and installers during the first quarter of 2024. In the US, the slowdown was mainly higher interest rates, high channel inventory. In Europe, the slowdown was mainly driven by a softer customer demand as utility rates dropped. Policy changes were implemented It seems like an awful lot of excuses why revenue went down. Let's go back to the income statement. Below revenue is cost of revenue. These are all the expenses directly tied to generating the revenue. Revenue minus cost of revenue gives you your gross profit, $116 million, down from $320 million. Then you have your various operating expenses, R&D, sales and marketing, G&A. Their operating expenses are higher than their gross profit, so they have an operating loss of $29 million compared to a gain of $167 million last year. Net loss of $16 million compared to a gain of $146 million. The one bright spot is their shares are going down. Last year, $137 million, now $136 million. Let's look at a balance sheet. Current assets, $2.3 billion. Current liabilities, $550 million. So a really high current ratio. They're sitting on a lot of cash, over $1.6 billion. You include marketable securities. Their total assets, $3.2 billion, a little less than last year. Total liabilities, $2.3 billion. Their biggest liability is debt, $1.2 billion. They have a good amount of deferred revenue, $359 million. This means they receive cash for a product or service that they're going to deliver in the future. Assets minus liabilities equals equity, $900 million of equity. They raised $940 million from selling their business. They lost $12 million from running their business. Let's look at the statement of cash flows. Positive operating cash flow of $49 million. So that's pretty good. It's positive. Last year, a lot higher at $246 million. Operating cash flow is the cash the company generates from running its day-to-day business. Net income on the income statement is their accounting profit or loss. Operating cash flow is net income converted to cash. They don't spend much in PP&E, only $7 million, $23 million last year. In their financing section, they bought back $42 million of stock. Let's look at a company on Simply Wall Street. Its last price, $123, $18 billion market cap, down 4% in the past week, down 30% in the past year. Here's their stock price since they started trading. Only $7 at IPO. And then it looks like in 2017, it traded around $1 a share. Imagine getting it for $1. It had a massive run up from 2019 to the end of 2022. It peaked at $336. It fell about 75% from November 2022 to November 2023. It fell to $76 a share. But it's up a good amount since that point, at $127, but trading well below half its all-time high. Simply Wall Street's valuation is $153. They say the stock is 20% undervalued. 38 analysts priced this stock at $128. Their revenue forecast for 2024 is $1.5 billion. Next year, $2.2 billion. After that, $2.6 billion. Their free cash flow forecast for this year is $370 million. Next year, $670 million. Then almost $900 million in 2026. Look how low their revenue was from 2013 to 2019. Then it really blew up from 2019 to 2023, $2.8 billion. But it has come down since then to $1.8 billion. They must have made some pretty big acquisitions in these years for their revenue to go up so much. This red line is their debt, blue line is their equity. And they were tracking each other pretty much every year through 2021. Now their debt is $1.3 billion, equity $900 million. But the green line is their cash. They have more cash than debt, so the debt is not a problem. The CEO's salary went from $300,000 to $450,000. Total compensation $20 million, tenure as CEO 7 years. In the past year, a couple of big insider sells and some smaller insider buys. 79% of the company is owned by institutions, 18% by the general public, and 3% by insiders. The biggest shareholder is Vanguard, then BlackRock. The billionaire investor, Thurman Rogers, owns 1.5%. Goldman Sachs, 1.2%. Then some familiar names, JP Morgan, BNY Asset Management. Their employee count went up a lot from 400 in 2013 to 3,200 currently. And the ticker trades on the Nasdaq, Deutsche Börse, Zitra, London Stock Exchange, Mexican Bolsa, Wiener Börse, and the Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation, we'll